Crude oil is a natural resource that is found deep underground in various porous rock formations. It is composed of hydrocarbon compounds and other organic materials that were formed from the remains of ancient animals and plants. Crude oil is extracted from the earth by drilling wells and pumping it to the surface. It is then refined into different products such as gasoline, jet fuel, and plastics. These products are used for various purposes such as transportation, heating, electricity generation, and manufacturing. Crude oil is important for the global economy because it is the main source of energy for many countries and industries. It also affects the prices of other commodities and goods that depend on oil for production or transportation. The supply and demand of crude oil are influenced by many factors such as geopolitics, environmental issues, technology, and consumer behavior. The price of crude oil can have a significant impact on the economic growth, inflation, and trade balance of countries that produce or consume it. Crude oil is traded in global markets where buyers and sellers agree on a price based on the quality and quantity of the oil. The most common benchmark for crude oil prices is Brent crude, which is extracted from the North Sea. Other benchmarks include West Texas Intermediate, WTI, which is produced in the United States, and Dubai crude, which is sourced from the Middle East. The price of crude oil can fluctuate depending on the supply and demand conditions in the market, as well as the expectations and sentiments of traders and investors. In this section, we will analyze the current market trends and factors that are driving the crude oil rally. Crude oil is one of the most important commodities in the world, and its price affects many aspects of the global economy. As of May 2023, crude oil prices are hovering around $86 per barrel, up from about $50 at the start of. What are the reasons behind this impressive increase, and can it continue? One of the main factors that boosted oil prices in 2022 was the unexpected invasion of Ukraine by Russia in October. This sparked fears of a major geopolitical conflict that could disrupt oil supplies from Russia and other regions. Russia is the second largest oil producer in the world, after the United States, and accounts for about 12% of global output. Any disruption to its production or exports could create a significant supply shock in the oil market. Another factor that supported oil prices in 2022 was the strong recovery of oil demand from the COVID-19 pandemic. As vaccination rates increased and lockdown measures eased, many countries saw a surge in economic activity and mobility. This led to higher consumption of gasoline, diesel, jet fuel, and other petroleum products. According to the International Energy Agency, IEA, global oil demand rose by 2 million barrels per day, BPD, to a record of 101.9 million BPD. However, while demand recovered, supply did not keep pace. One of the reasons for this was the decision by OPEC and its allies, known as OPEC+, to cut production by 2 million BPD in October. This was a surprise move that aimed to support the market amid rising COVID-19 cases and inflation concerns. OPEC+ is a group of 23 oil-producing countries that collectively control about 40% of global output. By reducing their output, they create an artificial scarcity that pushes up prices. Another reason for the tight supply situation was the lack of investment in new oil projects. The COVID-19 pandemic and the low oil prices in 2020 and early 2021 forced many oil companies to slash their capital spending and focus on preserving cash flow. This resulted in fewer new wells being drilled and less exploration activity. According to Rystad Energy, global upstream investment fell by 30% in 2020 and only recovered by 10%. This means that there is less spare capacity and less potential for future growth. Looking ahead, some analysts expect oil prices to rally further in 2023, possibly reaching $100 per barrel or more. The main drivers for this bullish scenario are: a rebound in Chinese demand. China is the largest oil importer in the world, accounting for about 14% of global consumption. However, its demand growth slowed down in late 2022 due to COVID-19 outbreaks and power shortages. As these issues are resolved, China's demand is expected to pick up again and support higher oil prices. A lack of sizable supply growth. Despite the high oil prices, many oil producers are reluctant to increase their output significantly. This is partly due to environmental and social pressures, as well as uncertainty about future demand trends. Some OPEC+ members also prefer to keep their output low to maintain market share and fiscal stability. As a result, there may not be enough supply to meet the growing demand. A weaker US dollar. The US dollar is the main currency used for international oil trade. When the dollar weakens against other currencies, it makes oil cheaper for buyers outside the US and increases their purchasing power. Conversely, when the dollar strengthens, it makes oil more expensive and reduces demand. The US dollar has been weakening since late 2022 due to rising inflation and interest rates in the US. This trend could continue in 2023 and boost oil prices. Of course, there are also some risks and challenges that could prevent oil prices from rallying further or even cause them to decline. These include a resurgence of COVID-19 variants or new pandemics that could dampen economic activity and mobility. A slowdown or recession in major economies that could reduce oil demand. A breakthrough in renewable energy or electric vehicles that could reduce oil consumption. A geopolitical conflict or natural disaster that could disrupt oil production or transportation. A policy change by OPEC+ or other major producers that could increase output and flood the market. In conclusion, crude oil prices have risen significantly in 2022 due to a combination of factors such as geopolitical tensions, demand recovery, production cuts, and underinvestment. Some analysts expect this trend to continue in 2023 as Chinese demand rebounds, supply growth remains limited, and the US dollar weakens. However, there are also some downside risks that could derail this scenario, such as COVID-19 variants, economic slowdowns, technological disruptions, or supply shocks. In this section, I will share some tips and tricks on how to profit from the crude oil rally, such as investing in oil stocks, futures, ETFs, or options. Tip number 1. Learn what moves crude oil prices. Crude oil prices are influenced by supply and demand factors, such as global production, economic growth, geopolitical tensions, and market sentiment. You need to keep an eye on these factors and how they affect the oil market outlook. For example, if you expect a rise in demand due to a recovery in global growth, you might want to buy oil futures or ETFs that track the price of oil. Tip number 2. Understand the difference between Brent and WTI crude oil. Brent and WTI are two of the most traded grades of crude oil in the world. They have different characteristics and prices due to their geographical origin, quality, and transportation costs. Brent is the international benchmark for oil prices, while WTI is the US benchmark. Generally, Brent trades at a premium to WTI because it is easier to transport and has lower sulfur content. You need to know which grade of oil you are trading and how it relates to the other. Tip number 3. Choose the right instrument for your trading strategy. There are many ways to trade crude oil, depending on your risk appetite, time horizon, and market view. You can trade oil futures contracts, which are agreements to buy or sell a specific amount of oil at a set price and date in the future. You can also trade oil options contracts, which give you the right but not the obligation to buy or sell oil futures at a certain price and date. Alternatively, you can trade oil ETFs or ETNs, which are funds that track the performance of oil or oil-related companies. You can also trade oil stocks, which are shares of companies that produce, refine, transport, or sell oil. Tip number 4. Read the long-term chart and identify the trend. Crude oil prices tend to move in long-term cycles that reflect the balance between supply and demand. You can use technical analysis tools such as trend lines, moving averages, support and resistance levels, and indicators to identify the direction and strength of the trend. For example, if you see a series of higher highs and higher lows on the chart, you might conclude that the trend is bullish and look for buying opportunities. Tip number 5. Pick your entry and exit points carefully. Crude oil trading can be volatile and unpredictable, so you need to have a clear plan for when to enter and exit your trades. You can use fundamental analysis to determine your overall market view and technical analysis to pinpoint your entry and exit points. You can also use risk management techniques such as stop-loss orders, trailing stops, position sizing, and diversification to protect your capital and lock in your profits.